All right, let's start. Okay, so we have done the first part. Now we have to do two more parts. We'll try to wrap it up today itself, right? Everything so that uh, just a second, guys. Tomorrow you don't have a class, right? Tomorrow,
No, sir. Friday.
Friday, right? So tomorrow you can do practice, and then Friday we can meet again, right? So that's how it is structured, guys. That's why. And again, the good thing is that these notes are very well made and concise. So you can refer these notes. Are very good in that way. Okay, a lot of CFA Institute questions are also covered here. Okay, books I have already shared with you and everything already shared in the group. Okay, latest books. In fact, they came day before yesterday only. They came 2026 books, right? So not very long back. Okay, all right. All right, let's move ahead, guys. So again, now we have three more concepts here in Module 2, time-weighted money and time-weighted returns and money-weighted rates of returns. So I'll give you the key idea in very short, right? Basically, one is money-weighted rate of return, one is time-weighted rate of return. And finally, we have evaluation of your portfolio performance, right? So money-weighted is you are weighing your rate of return as per the amount which is invested. Time weighted is you are weighing your return as per the time which has passed. And then evaluation of portfolio performance, you have different measures, right? So very small two, three concepts, but yes, you have to understand that, right? So let's talk about the first thing, which is the money weighted rate of return. When I talk about money weighted rate of return, please understand very, very clearly here that when you talk about your money weighted rate of return, the concept here is the IRR, right? It is the internal rate of return, IRR, right? IRR is basically the discount rate that makes the net present value of all investor cash flow, right, equal to zero, right? This means that NPV is equal to zero at IRR, right? So when you try to calculate your internal rate of return or the money weighted rate of return, it includes your timing of your all cash flows, the size of all cash flow, right? Taking into account all cash flows, outflows, right? So money weighted return is the IRR for the portfolio, taking into account your all cash flows and outflows, right? So cash flow include initial investment, contribution, withdrawals, final portfolio values, right? So both your timing and size. We'll do the questions. Don't worry, we will understand, right? So if your money is coming the first month, then the value will be different. If the money is coming in the last month, the value will be different. If the major amount is coming in the first month, the final return will be different. The major amount is coming in the last month, the final return will be different, right? So that is your money weighted, right? So timing and size both matter. Okay. Next one is your time weighted. When I talk about time weighted, please understand time weighted is geometric mean, right? Geometric mean, time weighted is the geometric mean of your sub period holding period returns, right? So it measures the compound growth, which is the geometric mean, and is the rate at which the $1 compounds over a specific performance horizon, right? Again, little difficult to understand, but what you need to keep in mind here is in your time weighted rate of return, you are removing the effect of external cash flows, right? Time weighted return is not affected by the timing of cash flows and your outflows and is preferred method for performance measurement because portfolio managers do not control the timing of deposits and withdrawals, right? That is one part. So in other words, I'll write down here with different color. Let me write down. Basically, when we consider TWR, time weighted return, please keep in mind you are basically the effect removing the effect of your external cash flows, right? Removing the effect of external cash flows by breaking breaking the overall period, breaking the overall period into your sub periods between your cash flows. Okay, then compound sub period returns. You see what is happening. You are breaking it down, right? You are breaking it down the overall period into sub periods, and then you are trying to compound those sub period return, right? So very tricky kind of method, right? Time weighted return. So that we'll try to understand. Time weighting, the process of averaging a set of values over time. The annual TWR is calculated by valuing the portfolio immediately before significant additions or withdrawals and form your sub periods over the evaluation period corresponding to deposit withdrawal dates. Calculate the HPR for each sub period, right? And then find the TWR. So what is happening is your your TWR is nothing but the sub periods which you have created. Let's say n sub periods you have created. So you are taking the 1 plus holding period return of first period multiplied by 1 plus holding period return of second period, right? Multiplied by 1 plus holding period return of third period, right? And that's how it will progress and ultimately last you have -1, right? And it why it is loved, because again in world of finance, since invest your portfolio managers, right? You are studying CFA for becoming a portfolio manager. Portfolio managers cannot control the flow, so they love this, right? Please also note that there is an impact if large funds are added just before poor performance. Your money weighted return will be lower than the your time weighted return, right? Because money weighted return, the effect of money will not come. Na? Effect of money, I told you, right? Just before poor performance, it has been added. Effect will not come. If large funds are added just before your higher returns, right? Then money weighted return will be higher than your TWR, right? So depending on uh, when the funds are added, right? Can somebody explain me, like if some, like anybody got the idea how does this work? Little tricky. I just want to check whether you have understood it or not. Can somebody make sense of these last two lines? Why it is said, you know, this way, right? Why there is this logic given that if large funds are added just before poor performance, money weighted return will be lower than the time weighted rate of return. If large funds are added just before high returns, money weighted return will be higher than your time weighted rate of return, right? Can you explain this very simply? Anyone? Little tricky, right?
Yeah, it's tricky.
Yeah, right. So yeah, that's what, like, see, listen to me carefully, right? This kind of question comes in exam. Please understand, when you talk about time weighted return, rate of return, time weighted rate of return, TWR measures the investment, measure how the investment itself performed. You are ignoring the money when it was added or withdrawn. So TWR is only about investment, not your uh, when money was added or withdrawn. Money weighted return measures how you personally did, includes the timing and size of your future cash flows, right? Now, in simple words, imagine you are investing in a mutual fund, right? So if you're investing in mutual fund, you add a lot of money before, just before the bad performance. Let's say you invest rupees 1,000, that grows to by 20%, and it becomes your 1200 rupees. You feel confident, and then once you feel confident, you add 10,000 more. And since you added 10,000 more, right, and then the market falls your 10%, right? Or let me write it down. This is a little tricky concept. I just want to make can remember it, but I'm just trying to put it in a simple way. Okay, so say you had invested initially 1,000 rupees, right? 1,000 became 1,200. You became very happy that, oh, I'm getting good return, 20%. Let me add 10,000 more. You added 10,000 more, right? Now, as soon as you added 10,000 more, within next few days, market fell 10%, right? Now, what happened was that your this part, right? Your how much, you know, 10,000 plus 1, 11,000. So 11,000 had become your what? Plus 1,200 was your return. So your total money with you was 12,200. Sorry, 11,200. Right? So you had 10,000. It was 1,200 rupees plus 10,000 you have put, right? So 10,000 plus 1,200, or 11,000 plus 200, whatever way, right? So you had money. You can add this way also. 10,000. You put your money which was there was 1,200. Right? So it was 11,200. Whatever way you want to calculate, you are 11,200. Now 11,200. Now your market crashed your 10%. Market crashed 10%. How much you will lose? 1120 you will lose. Nah? 1120 you lose. When if you lose 1120, right? 1120. So 11,200 minus 1120. If that is the case, I put it 10 to the 8, right? And 0, right? 0. I become 10,080. Right, so my money which I have it 10,080. So most of your money which is 10,000 experience the loss. So your personal money weighted return is low, even though the funds average performance wasn't that bad, right? So your 10,000, or in other words, you can say that your 10,000 money you put, right, that is actually in loss. If you remove this 1,200, kind of remove the money 1,200 which was made initially, so most of the loss is borne by your 10,000 investment which was done, right? So the whole idea which is said here, that if you put your money just before the bad performance, your most of the loss which you have suffered is actually suffered by your money, right? Most of the loss is suffered by this 10,000 rupees. That's why money weighted return is less than your time weighted return, because your most of the loss is borne by the latest money which you have put. Now in the other case, if let's say in the other case, one more, let me put it in other case, if you have, let's say, your 1,000 uh, rupees you have invested, that grows by 5%, not much, right? So in that case, your money is 1050. Now what has happened is you are very happy. You say that, okay, let me put it more money. You put 10,000 more, and when you put 10,000 more, market goes up. And just to put it calculation simply, let's say 10,000 goes up more, right? So the whole thing is that the effect, the 15% jump, the effect is felt by this 10,000, right? So the jump has come to this 10,000, right? So that's why your money weighted return is actually higher than time weighted return, right? So basic idea is that most of the money benefited from the gain. So your personal amount which has been invested recently got you more return, right? So whole idea is money, or if I put it very simply, just remember one line which I let me write down in the slide itself, not here. I'm writing it here. Please keep in mind very, very clearly that money weighted return punishes or rewards, right? Your timing, your timing and amount. So if market goes down, right? If market goes down, money weighted return will suffer. You will be punished. If market goes up, right, you will be rewarded, right? So, okay. So timing and amount are punished and rewarded by money weighted returns. Time weighted returns are not affected by that. That is why portfolio managers follow this, because otherwise every portfolio manager will put their money and change the returns, right? So portfolio managers are told to follow this method, right? Again, tricky, but just keep in mind that portfolio managers, the best method to use for portfolio manager is time weighted return. Okay. Next one is evaluation of your bond portfolio. When I talk about evaluation of your bond portfolio, please understand that when you're evaluating the bond portfolio, right, or evaluating any portfolio, right, very, very important to understand bond, equity, whatever portfolio you have, that you have time weighted rate of return. And now you would have got idea, because ultimately you don't want that timing of, or the money amount, or the timing, or the time when the money is coming, that should affect it, right? Manager does not control when the investor contributes or withdraws. TWR isolate the performance of the investment decisions. Manager skill in selecting issues. So that's what we like it. Evaluating the investor's personal portfolio, appropriate measure is money weighted rate of return. See again, when you are doing a personal portfolio, things are different. Well, you are evaluating a manager, TWR. When you are evaluating personal, MWR, the rationale here is MWR reflects the actual rate of return earned by the specific investor over the period, taking into account their own personal decision regarding when the money to invest or withdraw, right? So when you are taking your own decisions, follow your MWR. When you're judging manager, then that is, manager is not in control, right? Manager will be judged on TWR. You are taking your own decision. You are your MWR, right? Money weighted return, right? So this is what it is. Again, small question comes here. Money weighted is IRR. Time TWR is geometric, highly sensitive to the timing and size of contribution withdrawal that we've seen, not affected that we have seen. Reflect the return of investor who controls the timing of cash flow, we have seen. Return the manager independent of cash flow timing, right? That's we have seen. Again, see, these notes are very crux and very good, right? So very, very helpful. You will, instead of reading many pages in your book, you are just getting the crux thing which you need to focus on exam. Now let's go to the questions, guys. In questions, a fund receive investment at the beginning of each year and generate return for 3 years as follows. They get USD 1000, 4000, 45,000, right? Big money coming in the last year. 15%, 14%, 4%. Which return measures over the 3 year period is negative? Now, see, you're trying to calculate, there are three kinds of return given here, right? So how do you go about it, right? See, when you are trying to find, intuitively, right? Before I get into the calculation of each, intuitively, please understand, uh, when you are trying to calculate such kind of question, you need to be very clear that, uh, can I get the answer without going into calculation, right? So, or can I make it easier to understand? See, geometric, we just studied. If you go to the previous slide, we just studied that your geometric and TWR are same, almost same, right? This is the geometric mean of superior returns, and it is TWR. So what you get from both of them is that these two, A and B, right? These two will be similar in nature, right? Because both are geometric only, right? This is geometric, this is time weighted, right? And time weighted is also geometric, right? Only difference is time weighted is geometric of subperiod. So if I calculate one, right, I will get an idea of the other also, right? So that is the best way to solve it, that you focus on this one first. And since you focus on this one first, you can easily figure out, right? So now the TWR or HPR of one is given as your 1.15, right? Or let's not say HPR, let's say right, let's put it here. If I try to calculate your time weighted return, it is your 3 period, so root of your 3, and it will be 1.15 into your 1.14 into your 1 point. This actually, this is minus, guys. This is, maybe there is an error here. This should be minus. I think this is minus, right? So this is 0.96. You solve it, you get 7.97, right? So once you do that, right, you realize that okay, this my time weighted return is coming to me 7.97. So you're pretty sure, right, that geometric mean return will not differ too much out of it, right? So then I don't need to even calculate money weighted rate of return, because I know geometric mean and time weighted rate of return are almost same, right? Because time weighted return is also geometric mean return, right? So both are 7 point something. So that makes it easier for me to understand, right? Now, how do I calculate the money weighted rate of return, right? So for that, let's go ahead. I've told you an intuitive and easy way to kind of calculate. Now, money weight of return, consider both the timing and the amount of investment in the fund, right? So this is where your both things are calculated, right? So see, the calculation is very long. What I wanted to, and minus 4% also I told you, right? So what I wanted to show you here was that sometimes examiner is checking your understanding, right? Examiner doesn't want, see, even though this is calculated here, what I wanted to tell you was that you don't need to calculate so much. You just have an understanding that okay, if I time weighted rate of return is 7.97, that is similar to geometric, that will be also 7 point something. So if I, the only possible negative return can be money weighted, because first two are not possible, right? So again, the calculation here is this. The first one has been shown. The first one has been calculated. You can see new investment 1000, net balance 1000. The gain is 15%, 150, 1150. This goes here, right? 1150, new investment 2850, right? Because net balance, right? If you see here, here net balance is asset under management at the beginning is 4000. So if your amount was your 1150, the addition which has happened, this you have to assume, this you have to figure out yourself, guys. The addition which has happened is this, right? Nobody is telling you this. This you have to calculate yourself, because amount given was 4000, so you mean this was added, right? And then you earn 560, 4560, this is going here 4560. The final one is 45,000, so obviously this was added, right? And minus 4% USD, minus 4% is your 1800 of that, so final is 43200, right? So right, so you have to understand both timing and amount of investment to calculate the money weighted return. You have to tabulate the investment return, investment amount to determine the cash flows, and then this is how it is calculated, right? This is how it is calculated. Uh, you have. I'm not sure if you have bought calculator or not. Have you guys bought calculator?
Yes.
Okay, you have bought calculator. So
Yes, sir.
what I'll do today is I will guys, we will have a class tomorrow also. There is a reason why I'm telling you I have to stop, right? Because I realized that you know. Do you know how to use calculator? Like, are you proficient how to use calculator?
Yes,
Somewhat,
sir.
yes.
Yeah, right. So that's what I came to my mind, that this thing slipped from my mind, that you guys have to become good in calculator. So what I'll do is, because you will not be able to solve this, right? What is happening here, you will not understand, right? There is certain functions which are happening here, so there is no use for me to teach this right now, right? Because this is purely calculator stuff. And similarly, next question is also calculator, right? Next question is also calculator, right? But now what I'll do is I'll tell you few things about calculator, and then what I'll do is in your WhatsApp group I'll share some videos, right, about your calculator, right? So please do those today or tomorrow also, you have time. And then we meet tomorrow evening again for a count. That's why we separated days, guys, because these are very logical problems which come, right? So tomorrow again we have a class, and then once you have learned a little bit of calculator, then we come back and do this stuff, right? So what I want to add here now is that I will show you the article, or in fact the resource which I used in my CFA studies, right? And I recommend to everyone, and that is still available on internet. So I'll show you something now. So and then I'll add it here. So just give me a second. So what I'll do is, so can you show MWR? Yeah, so TWR, so I've shown. MWR I have not shown. Na? MWR I have not calculated for a reason. TWR you have understood, na, Anupam? TWR was simple, na? I think TWR there was no issue, right? Time weighted return was just HPR, right? 3 period return, 1.15 into 1.14. Anupam, I think there were some issues. 1.15 TWR you have understood, na? Sanyam and Hira.
Yes, sir.
TWR is easy. MWR we have not done. MWR, that is why I'm stopping here, right? So what I'll show you right now is article which actually I personally used, right? And I'll to be fair, I'm still surprised that that article is still existing after 15 years, right? Uh, like, I always get surprised when I share this article with students, because uh, maybe someday if I have the book with me. So guys, this article, it is, even though it is showing that this article is, I think, written on what, some November, right? I don't know what is the date of this article, uh, right? But this is the article which I still have. This is 17 June 2000, Sophia, right? So look, you will not believe me, but uh, maybe this weekend I'll travel to my native home, and once I'll get my CFA level 2 book, which I used. I told you, right? I still have CFA books. So CFA level 2 book which I used to study in 2013. In that book, this article's printout is still there. 2013 I printed this article, 2013, and I'm not joking, guys. I'll show you right. Or maybe I'll send you a picture in the group, just for telling you that I had printed this article in 2013 and stapled. Like, I'm a little bookish kind of person, guys. I love hard copies. So I have printed this article and I have stapled this article in the last page of my book, right? And this is a very good article. I'll share the link with you. right? And I'll tell every one of you that please study this article. This is a very, very good article. Unfortunately, I was not aware of this article in FRM part 1. I studied this article, sorry, CFA part 1. I studied this article in CFA level 2. So this is printed, and I've sent the link in the group, like link in the chat. So I printed this article. I still remember I printed this article, and it is kept in my 2013 CFA level 2 book. It is still there because last time when I opened, I saw this, printout, and I was just like, I was very like getting nostalgic that I have so many colorful things I have done in those books that time. So, those books I have not still thrown. Even some notebooks are also there where I made my notes. But this is a very good article. Go through this article, guys. This will tell you each and every step of what to do in your calculator. What are the three recommended settings in your calculator? Right? Three recommended settings in your calculator. Do that. Right? Set to 9 decimal places. Set the period per year to 1. Set the system to 1. Then learn these things. Right? How to, clear entries, memory. Please learn all this stuff, guys. All this stuff. Even though I don't think some of these things are not that useful for FRM part, sorry, CFA level 1, right? But at least for level 2 they are very much useful, and but please learn these functions. At least read if you can't remember, learn these functions. Learn these functions, how to use this one, right? All this, right? I'm sharing you what I have used, right? And they're very good steps, right? How to find crazy shortcuts to find standard deviation, variance, and mean. Very, very helpful, right? So if you are a student like me, please print out this thing, right? You know, and I still remember that when I printed out, I was a little stupid, and I didn't realize that there were so many comments. So the printout which came was 32-page printout. The comments also came out, right? So so I still remember that printing a mistake of mine. But anyway, this article is very good. What I want to say here, and please, 10 steps are given here, right? First is the setting, three setting recommended setting for CFA exams. Do that. Then 7 8 other steps are given. Do that, right? What exactly is, especially these functions, right? Clear TVM worksheet, clear work button, right? Please, very, very clear about that. Memory functions, right? Memory functions, if you can learn, very important. I didn't use memory function. I told you I was not aware of this article in CFA level 1. So, but in FRM part 2, I use memory functions a lot. Why memory functions are important? Because in exam, what happens is that your calculator is a computer, right? So you can store the memory. Like what is the mistake which can happen in exam? Let's say you got a value 19.967 or 19.964. In hurry, what will happen is that you will write down on your piece of paper 19.946, right? So what is the good way here is that you don't note down in notebook, you just store the value in the calculator itself, and in your notebook you write down that I have stored answer to the variance. Let's say you were calculating some value, right, which is used in the next calculation. So you will write down the piece of paper that okay, the standard deviation stored as serial number 1. So you're not doing the mistake of getting that number into your sheet and then putting the wrong number again. So later on, when you will go to some calculation, you just have to press recall 1. The number will come back, and then you have to multiply, right? So this is a big hack. In CFA level 1, I don't think this is such a lifesaver, but level 2, it's a lifesaver. Actually, it's a lifesaver. I'm not joking. You save so much time here in level 2, CFA level 2. So if you can learn in CFA level 1, I think that will be great. It saves you a lot of time. It saves you real lot of time. So learn these hacks, right? That's why I'm not going ahead. So I'm sharing a personal article which I love it. I still have it in my book. Very, very good article. Learn this. Don't think this is not in your syllabus. This all is in your syllabus. How to find standard deviation, right? How to find standard deviation, variance, and mean. If you can learn this shortcut, good. If you can't learn it, then there's a long way. But again, the point here is if you learn it well. Otherwise, don't learn it. Little tricky, little steps are more. If you are not able to learn it, then leave it. But if you can learn it, then you are definitely saving 30 seconds, 30 to 45 seconds in your per question, right? So that is the point. Very, very excellent article, personally used, personally still available in my book. So this is one. Rest I'll share you. That's why I'm stopping here, guys, today, because I realize, and we will have an extra class tomorrow to cover up the pending portion for this. So the point which I want to highlight here for you, that let me write it down. First is uh, practice your calculator. A lot of students think, sir, why should I becoming good in calculator? See, I told you very clearly, this calculator is nothing but a financial calculator, right? Secondly, the point here is, if you are coming for CFA, obviously you are coming here to pass all three levels, right? If you're coming to pass all three levels here, right, you must understand that calculator is very helpful all levels. Point is, a person who is good in calculator can easily save 15 to 20 seconds per question, easily. And 50 to 20 seconds per question, if you take it at bigger level, 100 questions, etc., then it is easily 15-20 minutes extra time. 15-20 minutes extra time gives you a lot of time, so that you can check your answers, you can revise your stuff. And secondly, it's not that difficult also, to be fair. It's more about a practice. It's like a computer, right? You have to just practice it, few days, 1 week or 10 days, little bit, half an hour kind of thing. Once you will get in practice, you will start using for your questions, you will become good. So prioritize. My point is prioritize, right? This should be priority. It should not, you should not think that calculator is not good. I have personally faced it in CFA level 1. I did not prioritize calculator. I was very slow, I'm telling you, very slow in calculations. In CFA level 2, I prioritized it, and I could see a vast difference. In CFA level 2, I had learned all these hacks and tricks which I just shared with you, right? And I had become very fast in calculator, right? So second part is that article which I have shared with you, right? Please study that article, do all these steps. It gives you everything. And third step is, I will share videos. I'll share videos of calculator, right? Videos of calculator, that has everything, right? Everything which you need to know about calculator, especially that will have 10-15 videos, small sort, 15 minutes, 20 minutes. But I will urge you guys, first you start with time value of money. You will find TVM videos. In that calculator, there will be TVM videos, time value of money videos, right? Time value of money calculation videos, right? Start with that. Then try. This is start with time value of money videos. You have to learn all. There is no stopping. You have to learn all, but start with time value of money videos and then study others also, right? So I'll do that once you are good with this, like at least you have some idea about it. Then we can come back and solve the numericals here. Otherwise, what I'll be doing here, you will have no clue. Tomorrow we will go a little slow. You can, what Anupam has asked the question, can we solve it? TWR, I had solved it. TWR was very straightforward. MWR, I'm deliberately not solving, because till the time you don't understand, like this is calculator function, guys. This CF0, this is a pure calculator function. What is CF0? How do you put CF0 in calculator? This is calculator. All these are calculator functions, right? Then you solve for IRR, right? Then you have to press a button called IRR in your financial calculator. The IRR will come out, right? So this is all calculator stuff. Till the time you're not good in calculator, we cannot proceed ahead. But I'll share with you, right? So we are stopping here today. Uh, I hope you have understood what I have taught you till now. If you have not understood, you can ask your doubt right now. Otherwise, we can take it tomorrow also. But till now, are you able to understand?
Yes,
Yeah,
sir.
right? Able to understand now. So that's good. Anybody any issues? Please share, guys. See, we are in this together, right? See, I teach a lot of places, and uh, you know, my focus is always. It's not like it's a aim is to make students pass, right? My objective is not. It's not about like it's not. I don't take it very casually, I would say, right? Because that's why I told you, right? I don't mind taking extra class tomorrow, but point is I don't want to go ahead till the time you don't understand, right? That's the whole idea here, that we go together. So I'll share everything. That's why I shared with you latest books also, right? Kind of. This is okay. I don't know where this. Okay, article. The link I have already shared with you, so that's fine. But we are in together. That's my whole point. So don't worry about it. Books are with you now. Hard copy from where, if that is personal choice, wherever you want to buy hard copy, that is personal choice. Soft copy I have provided you. This I have given you. Uh, Notes notes we are making here. That's good. And calculator, I have shared a personal article which I used, and then videos I'll share with you. To solve such kind of question, it is very important that we have good grasp over the your calculator, right? How calculators solve these concepts, right? So for since we are doing the first question, we'll see the solution here, right? So I've shared the videos. I hope that makes sense, right? And in this particular question, right, we're trying to calculate your TWR, right, time weighted return, right? And in time weighted return, the important part to understand was that we have to input different cash flows and then calculate the IRR. Right now, what are different cash flows here, right? So if you see, right, if you see this table, so in this, if you go back to the first solution, right? So the year of investment, the asset under management, and of the beginning of each year, right? When I take beginning of each year, that is $1,000, right? The starting point I need to identify, right? The beginning of year it was $1,000. The beginning of year it was $1,000. So that is what I have taken. Beginning of year minus 1,000. Why I have put minus sign here? Please understand that whenever there is cash flows, right, the invested cash flows are generally taken as the negative amount, and this is also a very big confusion, guys. Negative and positive, right? So if you go back and see the table again, right, the initial investment which you had, that is considered to be CF0. So if I write it here, the first investment which you got, the initial cash flow you got, right? So it is like you started the year at, when you, the first cash flow you got was your $1,000. Okay, so this money is you've got at present time, right? So it will be taken as minus value. Then you are talking about CF1. Now, CF1 is after the end of the first year, right? It is this is the beginning, this is the end of the first year. Now, when I talk about the end of the first year, you see this is balance at the end of the first year 1150, right? So you go here, right? Now, is this the same amount? No. Why it is not same amount? Because ultimately this, you see here, right? You see here what is happening. How much cash is coming? This balance was your end of first year. Then the net balance at the beginning of the next year was 4,000. So you added 2850, right? So the amount which was again added, right, which was provided to you was 2850, right? Then same thing here, CF2. CF2 again, your amount at the end was 4560, but your new balance at the beginning of third year was 45. So how much was received? Right, received was minus 40,400. And then we talk about CF3. CF3 is the amount which is now with you at the end of the year. Now, this amount, these all amounts are received, that's why they are negative. Now at the end you have positive balance of 43,200, right? So this is what you need to identify very very clearly when you do it for the first time, that you need to be very clear that especially when you are calculating your time weighted return is the negative values what you are receiving and the positive value, right? So three values are negative and one value is positive, right? That is what we have here. Three values are negative and one value positive, right? Three value negative and one value positive, but I have also written. And then you have to put in the calculator, right? So then you have to input in the calculator. This is the equation which is given here, right? Which is minus 1000 minus 2850 minus 4440 43,200. In your calculator you should, that's why I've given you the videos, I hope you learned it. You have to put the values in calculator for each cash flow. Don't forget to put the correct sign, because if you put the wrong sign the answer will be wrong. And then you will compute IRR, and when you compute IRR you will get IRR as minus 2%, right? So this is the IRR which is giving me the value, and you're equating it to zero, right? So don't bother about equation that much, because nobody will actually solve by equation. You will basically solve it by calculator, right? So remember that in calculator you put CF0 value, CF1 value, CF2 value, right? Be very very clear of your signs, right? This is negative, this is negative, this is negative. CF3 is positive, right? CF3 is positive, right? Negative, 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 and positive. And when you go back to your solution, right, the question which you were doing. So if you right, if you go back to the question here that we discuss again, right, that these two were very easy: 1.15, 1.14, 0.96, 7.97. And the question was that which of the three period the return is negative. Now if you see here, okay, the return is coming as negative, right? Minus 2.22, right? So answer here is IRR, which is coming by calculation, is minus 2.22, which is negative. Okay, that was the answer, right? So my point here is that learn, right? Learn from how to use calculator. That's why those videos were shared and one extra day was given. uh, the objective here is that you can't solve these questions by your equations. That cannot be done. These questions can be solved only easily by your calculator. You should know how to put the values. Those are given in your video. So we can't do that right now here, because you have to put on screen those things. That's not possible. Okay. All right. So let's do more question. You will
Question: there
realize.
is no difference between time-weighted return and geometric return.
No, there is a difference, right? Time weighted return. See, geometric return was 7.97 only, right? Geometric, in fact, okay, fine. So you are asking that what is the difference between time weighted return and geometric. So that is what we discussed last time. I think you missed little bit of definition. So if you remember when we discussed this definition, right, I told you very clearly that time weighted return is geometric mean of sub periods, right? In your geometric return you are considering one period. In your time weighted return, what are you doing? You value the portfolio immediately before significant addition of withdrawals and form your sub periods. So what are you doing? That in time weighted return you are dividing your periods into multiple kind of small periods, right? HPR1, HPR2, HPR3, HPR, right? The methodology, the calculation method of geometric mean return and your time weighted return is same. The difference is in geometric mean you don't do you don't have sub periods, right? You don't have sub periods. So you don't do this thing of dividing it into sub periods. Here what you are doing is you are saying that I am dividing a period, you know before any significant addition or withdrawals, right? And you are trying to form your sub periods and calculating the holding period return for each sub period, right? So this, putting one sub period, two period, three sub period, that is your TWR. So basic methodology is same, but implementation wise, geometric mean does not have sub periods. Time weighted return divide the whole time into multiple sub periods and try to give you a very precise estimate that even though both values will come near about same, but time weighted return, right, gives you more accurate value, and because it is divided into sub periods. Okay, make sense?
Yes.
Right? Okay, no worries. Right, so that is done, guys. So again, it is a little tricky. This part is also interesting. And now we start another question, right? This is another question. What we'll do is I'll try to give you some time to solve also, because uh, early days it is very important to become good at these things, right? So question number 7: at the beginning of year one, a fund has USD 10 million. Beginning of year one, right? It is not the end of year one, beginning of year one, right? So it is always like your CF0, right? Same concept which I told you, that whenever you have you know beginning part, you start with CF0, right? This convention you have to understand, right? Please try to understand. So we have CF0, right? CF0 is given to you, and what will be the sign of CF0? Right, I told you, right? CF0, you are receiving the money when you started the year 10 million. So this will be negative 10, right? Negative 10 million, right? Under management. It earns a return of 14% for the year. Okay, fine. So first year 14%. The fund attracts another net USD 100 million at the start of year two. So money is coming again to you, right? Again, money is coming to you, but it is not your money. It is coming to you, right? So same like earlier question, CF1, right? And why I'm taking CF1? It is because the see, keep in mind very clearly, beginning this relationship, please try to remember. Beginning of year one means end of year zero. Beginning of year two is basically your end of year one, right? We always, when we write 0 and 1, this is end values. Please remember this very clearly. In calculator, when we input the end values. So when I am saying to you, the fund attracts another net USD 100 million at the start of year two. Start of year two means end of year one. So end of year one is written like what? CF1. Beginning of year one, 10 million, right? Beginning of year one means end of year zero. End of year zero is written as CF0. This convention, please understand, guys, because you are basically trying to use a computer, right? And computer has a kind of algorithm, right? What is a computer? Computer is your calculator, right? So you have to put in the values what your calculator understand. Calculator understand values like this, right? So you have to put values like this in calculator. Okay, so keep that in mind. So CF1, so don't get confused, right? Don't think, sir, why are you doing this? I am doing all this because calculator understands like this, right? So CF1 is equal to, again, since you are receiving that money, it is negative sign 100, right? And earns a return of 8% for that year. Fine. The money weighted rate of return of this fund is most likely, right? Now we have to calculate the money weighted return. Right? Again, same concept, money weighted return. We have seen just now how money weighted is calculated. We have to calculate the IRR. It is done by your, you know, what you say, the calculator. Now, but the question comes is, what is CF2, right? How do we get the CF2 value? Because CF2 value I don't have, right? In the, what is the difference in this question and the previous question, right? Previous question you had CF2, right? In the previous question, the last value was given to you, yes or no? Are you getting my point? The last positive value was given to you, na? 43,200, right? This value was given to you, right? So last positive value given to you, if you read the question also, right, you understand that last positive value is given to you, right? It is, you have the, if you see here, right, by building this table, right? Okay, so here also, to be fair, okay, here also I should have shown you calculation. So what has happened is 45,000, then minus 4 has been done, right? 44, you know, if you have, so how did we get 43,200? We have calculated it, right? How did we calculate this thing? 45,000, the ending value, multiplied by your, loss of your 4% minus 0.04, right? That's how I calculated the value of 43,200, right? So I need the ending value. Now the question comes is that, okay, here the ending value I calculated, right? Here the ending value I calculated using whatever values I had, right? Same thing I have to do there also, right? So what did I do? 45,000 minus 4, 43,200. Now, how do I calculate there the ending value? I don't have the ending value. I only have the starting value. Let me delete this thing. So in this part, right? Sorry, I don't want to go ahead. But the whole point here is that how do I find the now your ending value, right? So ending value, how do I calculate is that I know I have received 10% first year, that earns your 14%. So that 10 million which I first year came to me, in the first year it earned 14%, 1.14, right? In second year, that 10 million earned 8%, which is 1.08, right? So this is the what your first 10 million earned, right? First 10 million earned 10 into 1.14 into 1.08. Then what is the other amount of money I have got? Other amount of money I have got is 100 million. 100 million I have got, that earns what? That earns 8% in the second year. Because that came in the after the first year, na? That was not there with you in the first year. That came after the first year. So we only have 100.08. Now if I solve this, if I just solve this, because the numbers are very simple, right? Numbers are very simple. If I just multiply and solve this, I get the value 120.31, right? In my calculator I get the value 120.31. So this value is the value of the ending value, and this is the your plus value, right? So this is my ending value. CF2 is equal to your 120.31. Okay. Now you put in the calculator, same thing. You input in your calculator CF0, CF1, CF2, two negative values, one positive value, and compute IRR, right? Put the values in calculator and compute the IRR. Right? Put values. Again, little tricky, guys, but please understand this is what you need to practice. We are giving you very solid questions. These all questions are actually from CFA, end of chapter questions, right? Right. So you are actually practicing good question, right? You don't even need to go home and kind of do it again, right? So these are hard questions. So do less question, but do quality questions, right? Don't do very easy question, right? That is what, right? Negative value, why it is there, I have explained you. How did I get this value? I explained you, right? Because 10 million earned this much plus 100 million earned this much, you added, you got your 120.31. Then this is the equation you are getting, right? Actually this should be, is equal to, right? And then you just compute IRR by calculator, use calculator, right? So use calculator to compute IRR, and you get 8.53%, right? This is your money weighted return. If somebody asks you that please calculate the time weighted return also, right? Time weighted return is very easy, right? Why time weighted return is very easy? Because first year, the first sub period, right? You asked me now that what is the difference between your geometric mean and the time weighted. So first sub period, the return was 14%, 1.14. Second sub period, the return was 8%, 1.08, right? And you take the under root, which is that's why you have this, so 10.96, right? So these kind of questions are very important to understand. This is the first chapter. Go back and practice it. But the whole idea is given here. Okay. All right. Please ask your question if you have any doubt. But overall objective is same. Okay.